What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is December 29th of 2022. Well, folks, I hope you all are having a fantastic day wherever you are, because in today's video, I want to spend some time to talk about buckling up for the ride to the downside over the next coming weeks. Not only are crypto markets relatively stagnant, but I want to spend some time today to really dive into the macro equities, talking about names like Tesla and Apple and the broader FANG or technology stocks, and try to assess whether or not we are in for a major move to the downside. And if so, how low can we really go? We got a lot of things to dive into today's video. If you happen to like it, drop a like. It's a great way to support the channel, and let's go ahead and kick off the rambling. So I want to go ahead and start off here by just talking a little bit about Bitcoin, because on the daily time frame, while things might look relatively boring, and to be honest, since really back in November during the collapse of FTX, we've been pushing sideways. This is very reminiscent of the collapse of Celsius. As a lot of the capitulation goes through, a lot of people are left wondering if there's any more contagion. Is there any more players out there that are still left out there who are, basically left with more debt than they have assets on their books, and therefore in a position of bankruptcy and having people left empty-handed to some degree, i.e. people thinking they're wealthier than they really are because of the mistakes of these companies. This is, again, the contagion that is still likely playing out in the crypto space, and seeing no clear signs of an uptrend, either here on the daily or more specifically on the weekly time frame, especially with the rejection we got after the CPI report and the FOMC meeting back during the week of December 12th, we can see that the momentum is still clearly to the downside. There is no trend change. We've been watching that market order flow, nothing serious yet. But I want to go ahead and talk about how this is not just me bashing on Bitcoin, and it's also not going to be me bashing on the other assets we're going to be talking about. It's just the market order flow, essentially. Is there an uptrend? Is there a downtrend? It's asking these simple questions. And are we seeing the signs that it's really time to buy the dip yet? I don't think so. And I'm always going to be as realistic as I can about this with you guys. Let's go ahead and take a look at the broader equity markets. First off, I want to go ahead and take a look at the Apple FANG index. This is one of our custom indexes that we track within the Dash report, and it's a great way to assess how the broader technology stocks have been performing. Now, it's important to understand the dynamics of what really defines a bear market. Bear markets are obviously defined generally by a certain percentage of decline, generally when you're making lower highs and lower lows, i.e. a downtrend in valuations, when price is kind of zigzagging to the downside versus the upside, like we can see in an uptrend, where lows are getting higher and highs are getting even higher, is the inverse during a bear market. But there's also something that really defines real bear markets. I'm talking recessionary bear markets like that of 2008, the dot-com bubble, these periods of time where equities go through not only more exacerbated corrections and percentage decline, but also define really a risk-off period. And that is when market leaders, the stocks that made up the vast majority of gains, became the multi-billion-dollar companies, if not trillion-dollar companies in the case of this bull market, that led the way in the bull market and outperformed general equities and as a whole. It's when those plays start to become market laggers. They start facing resistance at the typical buy the dip support range of the 200-day moving average, especially against the 200-week. And now we've seen these plays. If you add a custom index here between Apple and the FANG index, we can see that they not only were for months rejected by that 200-day, but now they faced resistance at the 200-week. They couldn't even hold the typical buy the dip indicator. And now we are in absolute free fall. If you look at this on a weekly time frame, week after week after week after week, these names are printing lower numbers. Now, this index makes it look real nice and pretty, but if we start to dive into the nitty-gritty, we can start to see that there are a lot of plays that are getting hit really hard here, and we need to talk about the magnitude of this. First off, let's go ahead and talk about Tesla. Now, I want to make something very clear here, because Tesla is a company that a lot of retail investors have exposure to. A lot of people love the vision of Tesla, and to be honest with you guys, I have nothing really negative to say about Tesla. Every company's got their downfalls and stuff, but I think Tesla has really reshaped the industry when it comes to EVs, and I've been tracking Tesla as far back as 2013. right? So don't take anything personal I say. I have nothing against Elon or the company. But I gotta be honest with you all, both Tesla and the broader EV market is still trading at a massive price to earnings multiple. When you come into bear markets, fundamentals come into play. During bull markets, fundamentals don't really matter. It's all future expectations. It's all expectations of growth. And the reason why it can get so exacerbated is because we don't know how profitable or how great Tesla can be. And yeah, sure, even a bear market, we don't know this exactly. No one knows the exact future. But during bear markets, what happens is that the market starts to reprice towards fundamental valuations. Tesla is now a profitable company. It has gotten through its rough patch period where it was on the verge of bankruptcy and has now become an empire in the automotive industry. But even considering that, we need to start repricing Tesla not as this crazy company that can do a million things all at once, but for what it really is right now, which is an EV automotive company. And it does have a degree of predictable profitability over the next couple of years. Now, when we dive into the chart here, I mean, you guys can start to see the market is doing this. Whether you agree or disagree with me here, the price action will show you this is what the market's doing here. It is having a massive repricing, and people are starting to consolidate or start to sell positions because it is still trading at a massive PE multiple. Now we can see that over time, as we've been going down in market valuations, and Tesla has been producing relatively decent earnings reports over the past couple months and past couple quarters, we can see that the PE, forward PE multiple, this is the important dynamic here. The price that Tesla shares are trading at according to their earnings, expected earnings in the future. Okay, now we can see here that Tesla is still trading at a 264 PE multiple. Now that's definitely much better than 873 like it was back over about a year or two ago. But we need to understand that this is still way, way above what it can be during a bear market, or what it should be during a bear market. So this is the key thing here. While Tesla might have some other tricks up its sleeve, it might have some really interesting innovations, while Elon being at the head is very exciting, again, we need to understand that we are stepping into a recessionary bear market, and leading plays like Tesla that completely blew other equities out of the water rallied from a weight-adjusted price of $12.45 all the way up to $400 in the matter of about 2.5 years. We got to be prepared for some much bigger downside. And we've been calling here in the dashboard group, we've been telling people to stay away from these big tech plays for a long period of time. Again, even Elon will tell you, we're in a recession right now. If you see from the insider selling, from his actions alone, he's been selling Tesla shares, right? It's not something personal. It's just the dynamics of the market. Right? So again, the key thing here is to wait for much lower prices. We've been calling for Tesla to potentially come down to $40 to $50 a share, come down essentially 90% in price. And that is to be expected from these types of market leaders that made absolutely exacerbated gains. Now, it's not just Tesla that I'm badgering on you, right? Tesla did major performance, and it's still overall for the past decade will be in a great position if it's at $40 to $50 a share. We got to talk about Apple as well. Even the more defensive, cash-rich plays like Apple that are much more predictable, have their user base, have their target audience, and always seem to maintain great profit margins due to their software business as well as their hardware. Putting that aside, though, no matter what you think about Apple, the chart is showing something else. We are seeing, just like with Tesla, an expanding channel here between the highs and the lows, right? Just gonna go ahead and just draw it out here, right? Don't need to be a TA expert here. Lower highs, lower lows, rejection now at the 200-day where we used to be able to deviate and get above that range. And now we're coming to test that 200-week exponential moving average and the 200-week. Not only would a decline down to this range still be a very heavy weigh down on the overall valuation of equity markets, giving you plenty of sell side pressure and capitulation across other stocks. Just going $10 down in the value of Apple shares is already going to be painful enough. But I'm making the case here that we are going to deviate below this 200-week. We are going to go down to a previous support range, something like here in February 2020 at $80, right? Something that we've seen in the past. That's really probably the next best level here for Apple. And what's really great about that is that if you, again, start to put this in percentage terms, it's not too crazy. Asking for Apple to do a 55% correction in the bear market, pretty reasonable, right? That's definitely better than it's fared in other previous bear markets. But the key thing I need to drive home here is that a lot of these companies can decline this much. I know a lot of people think, oh, Nick, Apple's so big, there's no competition that can step up to it. Why do you think it can go down so much? It's because these companies are entering into the end of their growth era. What is Apple going to do next that's going to justify its current valuation of $2 trillion? That's after on already, I think, about like 30 or 25% decline in valuations. Yeah, about 30% there, right on the dime, right? So Apple has already lost $1 trillion in value, right? But again, still at $2 trillion. What is going to justify Apple being at these valuations with corporate earnings declining into an upcoming recession? We really need to be realistic here and understand that the PE multiples, the price to earnings ratio, is going to decline here, right? Now, if you want to go onto the far end of the risk pool, I would say Apple is kind of the more defensive tech plays. Tesla, and also the broader FANG stocks are generally kind of the medium risk plays. We got to talk about Ark, the Ark Investment ETF. I think this is the peak of overt speculation on technology, small and mid caps, and the equity markets. Cathie Wood and the Ark Investment Fund really went overboard. They were the poster child during the bull market of heightened returns, outpacing the market, and now they are absolute market laggers. And I gotta say, I've lost a bit of my respect here for the approach of Ark because they continue to double down on their failing approach. They continue to buy the dip like every single unicorn did back in 2008, back in 2000, simply doubling down on their bad bets that are already underperforming the market. And this is just going to force Ark into a capitulation event. You can see it here within price, guys. Since back during August, again, when we went into cash, we've been betting against Ark here. We've been continuing to tell people to stay away from it. Don't buy what seemed like the dip. A lot of people thought, oh, we're back down to where we were in 2018. It's got to be able to bottom and rally up. And it's gone from $52 down to around a little under $30 per share. We've been calling for Ark to go all the way down here, back to where it was in 2016 to 2017. That still means Ark has another 33% to 50% decline in its valuation to come. And this is again why buying the dip does not work like it does during a bull market. There is not consistent standards within market price or market indicators to know when to buy the dip. And we need to understand that, for example, a 70% correction, the difference between that versus an 80 or 90% is astronomical. And you'd be much better off just staying in cash, not stressing, and waiting for the more opportune moments when there's real capitulation in the market. I think we're starting to see that a little bit here with names like Tesla. But again, people really misunderestimate how bad capitulation can get. What came up incredibly quick can come down very quick. And that's irrespective of what you think of these companies or your current asset allocation or exposure to these companies or a lack thereof. It's the fundamentals of market valuations and pricing. It is when fundamentals come back into check, where they have been gone for a very, very long time. It's time for people on the boards of investment companies to sit down and say, give me a better deal. This is still too overvalued. I'm not buying. Until we start to see much higher degrees of capitulation and therefore eventually consolidation, which we've seen, for example, in all the major indices here. If we go back here to the bottom of the dot-com bubble, right? Many relief rallies along the way that eventually led into a capitulation period where we had nearly a triple bottom in price. You can see that beautiful price formation here, deviation slightly below support range. And again, starting to press above that 200-day and get above there. That's the sign we got to see here, not trending below the 200-week. Same here with 2008. Nice double bottom formation, right? If you can remain patient and wait for the right optimal signs to start to play out in price, that is going to save you not only just a little bit of money, it's going to save you a lot of money. And it's going to give you the ample discipline and capital to come in at the right moment. And I promise you guys here, while we've been generally quite bearish here over the past couple of months, because I'm going to tell you it like it is from what I see. I'm not saying I'm always right, but I'm going to be very honest with you guys about when I get optimistic. And who knows, this really might be the last leg of capitulation here. And that's why I'm saying have your cash ready, focus on building a cash position, and get ready to strike when the time is right. But anyways, guys, if you enjoyed this video, if you enjoyed this kind of thought here, if you could, just drop a like. It's one of the greatest ways you guys can support the channel. It helps us to get this video out to more people in the YouTube algorithm. And it's free. If you guys enjoy the content, it's one of the best ways to kind of pay for it. I appreciate it so much. And if you're listening this long, I really appreciate that you guys listen to my rambling. It's something I was thinking about the other day. I've been able to do YouTube for over 5 years here. I've been investing for over 11, 12 years, and it's just been an incredible journey. But we're going to be able to make it through, guys. I'm going to be here during bull and bear markets, and for those of you who have continued to support the channel over the years, I really, really appreciate it. So thank you guys, as always, for allowing me to do what I do here. And until the next video, stay safe, trade smart, and I'll see you all in the next one. Take care, everyone.